Okay, so this is class 11. Today we want to try to get two things done. We want to do a little more practice for exam 1 for the tactical allocation and get you ready for the Zoom session so you can get even more practice. And then we'll start on the execution side. That's the break between exam 1 and exam 2. So when we get into that, it will be exam 2 material. So here's another example. We'll walk through this example. I'll read it, and as I'm reading it, we'll make some summary comments. I'll show you how I would do this if I were working this problem. So you might want to hit pause now so you can read through it. You might take some notes, but I'll do it as well. But so you can do it on your own, hit pause, and then in a few minutes, put it back. Start the video again, and I'll walk you through how I would do it so you can test yourself to see if you're picking up everything you'd be expected as a finance professional to catch. What I'm going to do over here on the side is keep track of her comments. So your boss has just provided you the following. Need to position our portfolio for 2020. I believe the economic fallout from COVID-19 will be much worse than expected. So we have weak economy. We already know what that means. Underallocate risk like stocks and move to quality. So that's a pretty straightforward one. Many are assuming there will be a rapid recovery in late summer or early fall, but I believe the economic downturn will be much deeper than and last much longer. So that's still a weak economy, nothing new there. Corporate earnings will fall and stay down for 4 more quarters as the so-called pent-up demand from consumers never materializes. So weak economy, we can add to weak economy and earnings. That gives us something much more specific to stocks. So consumers will be wary of spending even if COVID-19 cases drop off, given fears about a second wave in the fall. What we've actually seen is the first wave never stopped and it continues. So, all right, so nothing really, that all says one thing: weak economy, weak earnings. So we don't like stocks, especially low quality stocks. We want to move to quality, so high quality bonds, treasuries, high quality corporates and municipals. We don't want high yield. We don't want small company stocks. So that's pretty straightforward. So let's see if we can get some new information. So in that first paragraph, not much, not a whole lot to help us with the allocation other than the high level bonds over stocks. Europe and Japan will probably do better. All right, so Europe and Japan relatively stronger. Well, what are you relatively stronger? What are they? They're developed markets. All right, remember when we talk about developed markets, excluding the United States is the developed market, but when we say developed markets, I mean international stocks in developed countries like Europe and Japan will probably do better because they've handled COVID better and their economy should be stronger. We don't need that relatively stronger. That's enough there. The dollar, weak dollar. So they say the US dollar will weaken this environment. Interest rates in the US will continue to fall. Falling interest rates, that's pretty important. Will continue to fall to historically low levels. Rates will then stay very low with falling interest rates and low volatility of rates. Well, that's important to understand. Here she specifically talked about low volatility related to interest rates. She's not saying low volatility for stocks or for the economy. She's just saying for interest rates, they will be very stable. And that's probably because they're so low, they can't really move lower, but there's no pressure for them to move higher. States will stay very low and show little volatility as the Fed Reserve signals they will keep rates low for an extended period of time. Developing, emerging. Now don't get confused between developed, ED, and developing, ING. Those are two different things. Some students have gotten confused in the past. developing and emerging are one and the same thing, will fare the worst. All right, so I'm going to put that right below Europe and Japan. Emerging will be the weakest, and that's all we need to do is just say they're the weakest. As their healthcare systems will be inadequate to address COVID-19, as their trade with the U.S. will be weak for some time. Spreads on corporate and municipal bonds should widen. So widening spreads, especially for the lowest quality bonds, that just kind of is expected. Corporate balance sheets are highly levered after years of firms buying back stock and issuing debt, and municipals are facing huge budget crises in trying to respond to COVID-19. So we can say especially munis, and we have definitely seen that this summer. Municipal bonds have done really badly. So whoever wrote this up, I don't know where I got this from. I might have just created this myself. Usually I go out and try to find somebody else's opinion. But they had some of this right on. Although the stock market has definitely bounced back, corporate earnings have not. The economy still has some weaknesses. So who knows? We'll see by the end of the year. Municipal bonds are facing huge budget deficits, and so some special concerns for munis. And then we don't see anything at all about alternatives, do we? So what do we do with alternatives? I don't see a single comment in this whole thing that says alternatives will do strongly or poorly. So I'm just going to say nothing on inflation, nothing on alternatives. And then the marginal tax rate, remember, all we care about is the marginal tax rate. We don't care about the effective tax rate. The marginal tax rate is 25%. So that's what we have to work with. So if you see anything else in there that gives you some insight, put it down. But I think that's the entire highlight. So let's take this and let's try to then allocate to the different asset classes. So here are our asset classes. We have a weak economy. Interest rates are falling and staying low and very low volatility. Widening spreads, nothing on inflation. That might be the only thing we have for alternatives, is that we have nothing on inflation, so we don't really need real assets, and our marginal tax rates. So let's start with long treasuries. So for long treasuries, there's a couple reasons we want to overweight here. So we want to overweight. Why? Interest rates falling. So increase duration. Remember the word we don't use increase. So just to show you how picky I am, we say the word lengthen. Duration. Why else do we want to overweight? Weak economy. So move to quality. So there we have it for treasuries. Two things on treasuries. So let's go to tips. On tips, we are going to underweight tips. Tips is an easy one. Remember, tips are inflation index securities. So underweight, why? Inflation, not a concern. Very simple. You can just see that right up there. So there's nothing on inflation, but the economy is going to be weak and interest rates are falling. You can be pretty sure that if interest rates are falling and staying low, that inflation is not a concern. Mortgage-backed securities, here we want to underweight, overweight. And here is interest rates will be stable, so we want to sell convexity, which means buy negative convex securities like mortgage-backed in order, now this is important, in order to capture the higher starting yield. You notice that it's 2.9% versus only 1.25% for treasuries. Bill Gates doesn't like the word convex, but I'll leave it in there. I use that word all the time. Hopefully it is a word. So we want to overweight them. You might own treasuries, say overweight, though preference for mortgage backs. See below. You can certainly put that some in there. I've had students say underweight, and they may say underweight because we prefer mortgage backs. However, long treasuries look good because interest rates are falling, and long treasuries look good because the economy is weak. Just put everything down. I mean, that's the key, is make it real clear. Don't make me have to read between the lines, because I won't. I'll grade based on what you say, which is also what you have to do in interviews and when you're in business. You need to be real clear. If you say underweight treasuries because you prefer mortgage backs, make it real clear that you still like treasuries because rates are falling. You still like treasuries because there's a weak economy. But if you had a choice, you'd like to get to 2.9% for the mortgage-backed security, given that interest rates are going to stay stable. Now, some people say, well, rates are falling. Isn't that bad for mortgage-backed securities because of prepayment? You can put that down as well if you want. Some caution with rates falling and higher refinancing. If you want to put that down, that's great. I'll give you extra credit for putting that down. You get full credit if you have the first bullet, but I would definitely give you a few extra bonus points for putting that down. And in municipals and corporates, we'll talk about this together. But let's talk about them together, starting with medium quality. So we're probably going to say, let's just put, let's talk munis and corporates combined. Let's just say underweight. Why? We prefer higher quality, not medium quality. So we prefer, if spreads are going to be gapping out, it definitely would not be a good idea to be buying medium quality bonds. You probably want high quality bonds. So that's the first thing. So given the weak economy, make sure you put everything down. I'll probably give you full credit if you forget, but given the weak economy, so tell me why you prefer higher quality. Prefer longer term or longer duration if you want to. Given why? Falling interest rates. Don't say you want longer duration because you expect a weak economy. You need to tell me durations tied to falling interest rates. Now, I realize a weak economy implies falling interest rates, but it doesn't always. Here, she specifically said she expects interest rates to fall. So you have it in the answer. Now let's take munis versus corporates. So let's do the tax adjusted yield. Remember, you only do that with municipals. Their yield is 0.275. We divide that by 1 minus the marginal tax rate, which is 25%. When we do that, we get 3.67%. So we'll say prefer munis. Now you can put a caveat in it here. So prefer munis due to higher tax adjusted yield. If you want to put a caution in there, that's perfectly fine, given that your boss specifically said municipals are going to have some struggle here, given challenges with state and local budgets, lower tax revenues, however you want to say it. So if you say, let's say you don't want to recommend municipals because in her discussions she specifically said munis would be under pressure. So the best way to say that is while municipals have the higher tax adjusted yield at 3.67. So that way I know you know how to calculate that number. You know that 3.67 is higher than the 3.35% that you see up here for corporates. So let me know that you understand that. But if you want to underweight, you say even given that, I still recommend underweighting municipals versus corporates, given the challenges COVID-19 pushes for budgets for state and local governments. Or you can quote her directly. You know, she specifically said, corporate balance sheets are highly levered. Municipals are facing huge budget crisis. It's hard to say, you know, it's hard to say she's really saying municipals are worse. So I might caveat that, you know, she's kind of saying this. So I might say the corporates are also struggling with high leverage. So, you know, it's hard to say which she's really saying is worse. But if you want to put those caveats that's in there, but just make sure you show something on quality, you show something on duration, and something on taxes. So credit quality, durations. So remember the DC cuts I. So we got the D, the second C, and the T, DCT. Make sure you have that on municipals and corporates. On municipals and corporates, the quality and the duration will be the same because they're both medium term, medium quality, or they're both intermediate term. And so you talk about that together. So we underweight them. We prefer the mortgage backs. We prefer the long-term treasuries. We prefer higher quality corporates. We don't have that option here. And then on municipals, we have a preference for munis because they have the higher tax-adjusted yield, 3.67% versus the corporates, 3.35. However, there's some caution. State and local budgets are going to be really stretched, but corporates are stretched as well, so who knows? We'll probably come down to preferring municipals. High yields, piece of cake. Here, we're just going to say underweight, and very, very easy to say why we're underweighting this. Just a weak economy. Not much more to say there. And then remember, you need to add one that I don't have on the list, and that's stocks versus bonds. We prefer bonds, especially high quality, over stocks. And what's our rationale there? Again, because of the weak economy. And if you want to add in and falling earnings, that's more specifically related to stocks and the lower quality bonds. So there you got that answered. Large cap, low beta stocks. All right, so this is one where students really struggle. So I'm going to say within stocks. Why do we say within stocks? Where we're going to cut back on stocks overall, but within the stocks that we keep, we want to overweight. Why is that? And here's the biggest thing students miss on this question right here is they don't put two things here. So we prefer higher quality large cap over smaller cap in a weak economy, and we prefer low beta stocks over high beta stocks in a weak economy. So I have two things down there. A lot of students just say they prefer large cap low beta because of weak economy. Well, that's true, but is it because they're large cap or is it because they're low beta? And it's both of them. There's two things going on there. They're large cap. It could be large cap high beta. Then you'd have a problem. You prefer the large cap, but you prefer not to have the high beta. But here you have two things, so you need to say both of those are good. The large cap is good relative to the small cap. The low beta is good relative to high beta. And in small cap, the same thing. Here we don't have to say within stocks. We just say underweight. We just do not like small cap. We don't like stocks, and we definitely don't like small cap. What are we going to say here? Prefer, and you can almost copy what you did for large cap, but go ahead and put it down again. And then here we prefer growth stocks over value stocks. Remember, value stocks are very low quality companies. That's the reason they're so cheap. They have a lot of debt. They have a lot of problems. Growth stocks are much stronger, have better balance sheets. So in a weak economy. So yeah, it is exactly verbatim the same thing twice. Let's say it twice so I understand that you see that there's two things there, small cap and value. All right, then developed market, again, we're going to say the same thing. We're going to overweight developed market stocks. And why? Again, two things. But here again, I need to be real clear and say within stocks, overweight. We might underweight them in total, but compared to other stocks, we'll probably overweight them. And why? Relatively better performing economies than U.S. and emerging. Secondly, weakening U.S. dollar. So you got those two things in here. Here's where you bring in the currency. We got the currency there. And in emerging markets, this one's a piece of cake. We underweight much weaker economies than U.S. and developed. So very easy, just straightforward, put it in there. And then alternatives. We didn't get much on alternatives, but I'm going to say inflation appears not to be an issue. So real assets not needed to protect from inflation. Gold, not helpful given low inflation, but might help if economies go into crisis. So however you want to say it, this is one on alternatives. I didn't give you much in this one. I don't know why I didn't give something more specific on commodities. I mean on alternatives. You could certainly say something commodities like steel and energy might do poorly in a weak economy. So here you just have to make some stuff up. I didn't have many points on this one. Anyway, so there's a few things there. You really just need to get one of them. But so if you look at it, we've got 1, 2, let me actually even number them. 1, 2, you almost always have, you will have two things on treasuries. 3, if tips are in there, there'll be one thing on them. 4, if mortgage backs are there, you have one thing on mortgage backs. And municipals and corporates, you always have 3 things, and some students don't only get one of them. So there you've got the quality, the duration, and the taxes. High yield, there's only one thing there, so that's easy. Stocks versus bonds, one thing there. Large cap, a lot of students miss points here because they only give me one of them. Small cap, another place where students lose a lot of points because they only give me one. There's 13. Developed, there's always 2 things there. It's something to do with currency and about their economies. One thing on emerging, notice I did not say anything about the US dollar being weak on emerging countries because it's a little bit of a mixed bag because a lot of emerging countries actually are tied to US dollar. And then on alternatives, 17 or 18, just depends. You know, you want to get at least one thing down, so make something up, use your judgment. This is the critical thinking. So there were 17 to 18 things on this exam. I probably had 17 and might have given a few extra bonus points if someone said something really strong on alternatives. So this is how you need to approach it, and you need to write your answer very much like this. And see how I summarize it, so I make sure I had everything. I was looking there hard to find anything on commodities, and there just wasn't anything at all to help us with commodities. So you just have to make stuff up. For everything else, I had plenty of information to have discussion. Now on some of them, I could put some caveats, and it really is that complicated. None of these are so simple and straightforward that there's an obvious answer for every single one of them. Some of them are more obvious than others. So use your critical thinking, be rational, put good answers down, be thorough, and you'll probably do okay. It's the students that rush through this and just put the real simple, quick stuff without really thinking. This is a critical thinking exercise. So put some time into it. All right, so let's move. So that's it for exam 1. You have those 2 questions. We've gone over them. We'll do the Zoom sessions, get you ready. So hopefully you're getting stronger at this, not just for the exam. Who cares about the exam? The key is that you understand this so you can make good decisions, make good recommendations, really understand what it is that we do in investing. So great exam to really test to see your comprehension. But now we'll move to that, remember that 3rd question. We had the why, what, and how. So now we move to the how question. You decided what you want to invest in, how much in U.S. large cap, how much in treasuries, how much in high yield bonds, how much in developed market stocks. So now you're ready to execute. So we'll jump back to the class notes, page 27, and we'll reference what we did earlier in the class is on the how question. The 2 questions you have to ask there, are you going to do this yourself? Are you going to outsource it to a professional? The second question, are you going to be active? Are you going to be passive? So the first question, if you do it yourself, that's called security selection. You are going to decide which specific stocks and bonds to buy. You'll need a broker, and I highly recommend that you have a broker already. Even if you don't have any money to invest, go to a firm like Ameritrade. Their webpage is thinkorswim.com. thinkorswim.com. You can use Robinhood, which some people do. There's probably some other online platforms. And I know thinkorswim.com will let you set up a paper portfolio. Charles Schwab probably does as well, now that they're all related to each other. And just start trading stocks, even if it's with just play money. So you really want to do that before you're interviewing for jobs, so you can say that you're doing that. So that's pretty important. So you need probably an online broker. Brokerage used to charge $40–50 per trade. Now it's essentially free. If you look at Charles Schwab and some of the others, Ameritrade, Robinhood started this with just absolutely free trade. So they make your money on essentially like a bank on the spread between what they charge you for borrowing to invest and what they pay on their cost of capital. So it's a very different business now. They don't make a lot of money on trades. So that's why an online broker makes sense, because you really don't want them to do anything for you, because you want to keep it cheap. You want to make all the decisions. But you have to decide, are you going to buy Apple? Are you going to buy Walmart? Are you going to buy Delta Airlines? Which stocks do you want to buy? Which do you want to avoid? Or you can go hire someone else, and we'll talk about this as well. These are both very difficult things to do. So if you're not going to do it yourself, you're going to hire someone. Whom will you hire? You pick what we call a money manager or a portfolio manager. Firms like Fidelity, Vanguard, BlackRock, Victory Capital, who took over USA's portfolios, T. Rowe Price. There's a lot of firms out there that manage money, obviously. In fact, I heard one statistic once that there's more of these mutual fund managers than there are actual stocks in the U.S. That's possible because there's a lot of people out there managing money. So you pick a money manager and invest in their portfolio, and then they do the selection of securities. So that's the first question. Most people should probably outsource. They should probably go to a Vanguard or Fidelity and just turn it all over to them. So that because it takes a lot of time to figure out which stocks you want to buy. You remember, there are MIT PhDs that are spending full time every year trying to pick which stocks to buy or sell. So that's why you're competing against. So if someone only has an hour or two a week to do this, they're going to be really outnumbered with the professionals who are spending their entire 50 weeks, 50 hours, 60 hours a week doing this. So the second question is active versus passive. Active, you're trying to beat the market. You can do that at two levels. You can do it at the asset class level, like we just did on that exam practice, where you say, oh, I think we're going into a recession, so I'm going to underweight stocks and overweight bonds. That would be an active bet on the asset class level. And then you can be active at the security level. You know, Apple stock, boy, it's a $2 trillion market cap. That's too big. They've got to come down. I'm going to underweight Apple. And, you know, Nordstrom's, boy, they just had a really bad time of it this summer with their stock price. Our Norwegian cruise lines, their stock prices are so beat down. I'm going to put more into those stocks and pull back on Apple. Yeah, you could certainly do that. That would be security selection, and that would be trying to beat the market. Or you can be passive, and that's where I put Jack Bogle down. Jack Bogle is the founder of Vanguard. Vanguard's the second largest money manager in the world. Last time I saw, they're getting close to 5 trillion. BlackRock is the largest with about 6 trillion. I don't know if it's 4 and 5 trillion or 5 and 6 trillion. Given that the stock market's up so much, they're probably at the higher end of that range. And Vanguard really started the passive investing craze, where you just what you call buy the market. When Jack Bogle came out on this, his argument was you buy the market, and not necessarily that buying the market always wins, but before fees, but after fees, buying the market wins because it's so cheap. So if you're paying Fidelity 1%, the money is your money, but Vanguard, you only have to pay 0.02%. You're starting off 98 basis points or 0.98% ahead. You're probably going to win. And in fact, and I'll show you, yeah, passive investing does win about 90% of the time. So you save on fees. When Jack Bogle first started this firm, we may have talked about this earlier, but when he started this firm and wanted to charge lower fees, he was actually sued by the industry, and they say you can't do that. You can't charge your customers so little. You got to charge them more. And he won his case and was allowed. It's amazing. That's how bad the industry was, actually suing people for being competitive. And he won that. So I'm a big believer in passive just because it does win on average 90 to 95% of the time. So most small investors are better off outsourcing to a firm like Vanguard and just buying a passive index. And even Fidelity now has passive mutual funds. It's interesting, in the 70s when Vanguard started, Fidelity put out a major advertising talking about how stupid Vanguard was to do this. And they said, passive investing, that's mediocre. You're just trying to be average. Who wants to be average? It's un-American. Well, Vanguard did so well, Fidelity had no choice but to start offering passive mutual funds. And they now have a lot of them, and they have a lot of money in those funds. So Jack Bogle, before he passed away, he used to talk about how funny it was that his competitors would make fun of him, and ultimately they converted to his approach and now have very large passive funds. So let's talk a little bit about Jack Bogle and another good writer that I like a lot, James Montier, and then my own findings. So if you're going to do this first thing, which is, if you're going to outsource, so you're not going to do it yourself, you're going to outsource. You need to select a manager. What has history taught us that does well? And so Jack Bogle wrote a book called Don't Count on It. So I have some of his ideas in here. James Montier, he was at GMO. If you go to gmo.com, they have a lot of great readings that you can try out, and he's one of their best writers. In fact, I have a PDF of a lot of his articles. It might be all the articles through a couple of years ago. This is really good. If you ever want that, just email me. He's a really good writer. He has written some excellent articles. But he also wrote a book that I do recommend, The Little Book of Behavioral Finance. So both of them talk about three things when you're hiring a mutual fund, and we'll talk about mutual funds a little bit more, but you hire another manager, you don't want to do it yourself, you want to hire someone else. How do you find a good manager? And here's the three things they talk about, and number one is management fees. Mutual funds that charge low management fees outperform funds that charge high fees. It's very different than most other industries. Most industries, if you pay more, it's usually because the product is higher quality, you're getting better service, better performance. Mutual funds, that's not true at all. Higher fees in mutual funds means lower performance. You'll get a lower return, you'll do worse. And that's an easy one to actually check on. So here is a Fidelity mutual fund. This is an active fund. This is a fund where I was. We had a few $100 million invested with them. Knew the fund well. It's interesting. The title is interesting. Contra fund. It implies that they're going against the market. If the market's buying tech, they're going to be buying consumer discretionary or something. It implies a little bit different strategy. So this gives you the details on how they performed. But if you click on this button, profile, I'm in Yahoo Finance, and I just look for Fidelity Contra Fund. Its ticker is FCNTX. We'll talk about mutual funds here pretty soon. But you click on the profile, and it will show you down here below, it will show you their expense ratio. Their expense ratio is 0.85%. Remember, with basis points, that's 85 basis points. Remember, 100 basis points is 1%. So 0.85% is 85 basis points. The category average is 105 basis points, or 1.05%. So they're a little cheaper than average, but they're still kind of expensive. The nice thing is they don't have any front-end load. You can see there's firms that have, I think this average is the average of those that do have a front-end load. It's 5.38%. I would think that the average will be much lower than that. The median's got to be 0% because many don't charge at all. Now think about that. That's ridiculous. Not only are you paying a higher fee every year, but up front you're paying 5% off the top. So if you give them $100,000, they are going to take over $5,000 of your money off the top. So you start with $100,000, and suddenly on day two you're down 5%. You only have $95,000. And then some have a deferred load. So let's say you invest with them in January, and December you say, hey, you know what, I don't like them, I want to take my money out. They're going to take another $1,450 away from you at the end of the year, or whatever 1.45% is. So pretty ridiculous. We can go back and look at this fund. So you're paying 85 basis points where you could just go to Vanguard and just buy the market. And so you have to ask, well, is it worth it? Should I pay Fidelity 0.85% when I could just you know, buy the market? So here's Fidelity's fund, and we can compare it. Let's compare it to the S&P 500 and just see how they've done. And here we have it for just year to date, but let's do 5 years. If you do 5 years, you'll notice that the S&P is up 73% over that time, and Fidelity's up 68%. We could compare that to a Vanguard fund. Okay, so let's look at VFINX, that's the Vanguard fund. And here's the screen. Let's expand the screen. And we'll compare it to the SPY. The SPY is the S&P 500 as well. And then you can see that actually the mutual fund, and they're pretty close. It's hard to tell. If we go 2 years, you see a little bit of difference between the two, but it's hard to tell the difference. Every once in a while they get off, but they move right together. And so if we look at the profile, we'll notice that their fees are only 0.14%. That's a lot lower, and they have mutual funds with much lower fees than that. Obviously, no front end or deferred sales loads. Very, very low. That gives them just over Fidelity. Remember, Fidelity is 85, so that gives them 71 basis points advantage over Fidelity. So Fidelity can't just beat the market. They have to beat the market by 71 basis points, and even then they'd only be tying Vanguard. So that's why Vanguard has such a huge advantage, because they charge so little in fees. Okay, so there's management fees. Turnover. Turnover is how often the firm trades stocks. Are they trading constantly? I had a mutual fund I was responsible for. It had a turnover ratio of like 300%. I hated that mutual fund. Oh, it's such a hard. We had a strategy that I did not believe in, and we had to just execute it. If you look at a fund like the Vanguard fund we just looked at, its turnover would be very, very, very low. Some funds will have higher turnovers. You can get the turnover out of Yahoo Finance. And you're usually, if you have two funds or 4 or 5 funds, you're trying to choose between them. If you pick the one with the lowest fees and the lowest turnover, you will probably get the best performance over time. Passive funds, index funds like the Vanguard fund, have very low turnover because they're just buying the market. They really don't have any need. The only reason they have turnover is if the S&P 500 kicks out a company and brings in a new company, and then they have to buy and sell on that. So back to the contra fund, you can see the contra fund's turnover is only 26%. It's pretty low. If we look at the Vanguard, VFINX, and see what their turnover is only 4%. Now, I don't know if I can find the firm with high turnover. I can't think of any. I'm trying to think of the fund I used to manage, and I'm not sure what its ticker is anymore, and it may not be in existence anymore. But yeah, some funds have really high turnovers, and some have lower. The Fidelity did not have that high of a turnover. You will see turnover ratios well above 100% quite frequently, and those are just firms that are just constantly buying and selling stocks. And if you think about it, if you're investing for the long term, you're a really long-term investor and you have a long-term strategy, you shouldn't be turning stocks over constantly. Why would you think, well, this stock will do well the next 2 weeks, but not after that? No one has that kind of crystal ball to be able to project stocks. So those are firms that are just, they're just probably just trying to follow the market, go with the wave, and constantly making mistakes and having to make adjustments. That's very expensive. You have a lot of trading costs that we'll talk about in doing that, but it's also showing really bad biases, bad technique, bad processes to have that kind of high turnover. So after turnover, it's your percentage gains versus your percentage losses, and the key there is small investors make a huge mistake. Small investors, the reason small investors, individuals investors, those that do it themselves, most of them have very little training in investing, and the reason they so materially underperform markets is because when they buy a stock and if it goes up 5-10%, they sell it. They get nervous and they sell it. But if it falls 10, 15, 20%, they keep holding on to it, and they'll say, I'll sell it once it gets back to what I purchased it at. So I bought it for $100. It's $80 now, so I've already lost 20%. But if it gets back to $100, I'll sell it. Then it falls to 70. Then it falls to 60. And so what they do is they sell their winners too fast and they hold on to their losers too long. And that is a very common bias with small investors. I remember hearing a high school teacher saying, you haven't lost any money until you sell the stock. And I just shook my head. I didn't argue with him. But I don't believe that. If you buy a stock and it falls 40%, you've lost 40%. You haven't realized the loss. You haven't sold it yet, but you've lost 40% because that's what the market thinks it's worth right now. Now you say, well, I haven't lost it because it could come back to 100. Yeah, it could come back to the 100 if the market for some reason changes its opinion. But right now they think it's worth $60. And they may think it's worth $40 next week. So the key isn't what you bought it at. You don't care about that other than for tax reasons. You bought it for 100, now it's worth 60. You might want to sell it just to get the tax loss deduction. However, if you bought it for 100 and it's now trading for 60, but you think it's worth 40, so you bought it for 100, today is trading for 60, but you think it's worth 40, you should sell it for 60. Ignore that $100. Other than for tax reasons, you don't care about that $100. The key is, what is the stock worth today? But small investors get nervous and they tend to sell their gains too fast and hold on to their losers. Well, guess what? Professional investors, portfolio managers do the exact same thing, and you'll notice it in the ratio of their gains versus their losses. So you want to find a manager who is balanced between realizing gains and losses. That actually helps you from a tax purpose as well, because if you're constantly realizing your gains but you're holding on to your losses, you're constantly paying taxes and you're not getting any deductions. And so from a tax standpoint, you're better off. But also, this just shows these are far more sophisticated and disciplined managers. So those are the three things you'll get from Jack Bogle and James Montier. And then there's two things I discovered when I became a portfolio manager at USAA. I was responsible for $30-something billion in mutual fund. And so I was curious, who are the best people in this business? And why are they the best? And Vanguard always came out at number one. So I was just curious on what they did. But one of the first things I noticed was reversion to the mean. What that means, if you have a fund that has long-term been doing pretty well, has a 10, 15-year pretty good record, but recently has underperformed, they're probably the better fund to purchase. A fund that has a long history and they've done pretty well, but recently they've done really well, that's probably a fund to avoid. And that's called reversion to the mean. Funds that are doing really well above their average recently are more likely to perform under average going forward than above average. And funds that have been doing below average recently are probably more likely to perform above average. Now, this is not a strong relationship that you can really bet on, but if it's a tie between 2 or 3 managers, I would pick the one who has recently done the worst, because they're more likely to turn around, and that's just reversion to the mean. Hopefully you know that term, reversion to the mean. If not, it's a good one to look up on Wikipedia. It applies to a lot of finance and to other areas outside of finance as well. And the other thing I found, especially with Vanguard, was manager longevity. What that means is how patient is a firm when a portfolio manager has a period of underperformance. Maybe she's had a great 10-year record, but her last 3 years she's been in the bottom 5-10% of all managers. And you say, wow, 3 years of really weak performance, we better fire her. Well, actually, where I worked, it was 1/4 of underperformance, and they were talking to me, when are you going to fire this company? When I started as head of equities, everybody was asking me, when are you going to fire Firm X? I think it was MFS was the name of the company. When are you going to fire them? It was an international stock portfolio manager. They had a really bad year, and constantly the board was asking me that. All the employees were asking me that. We're getting complaints. And we looked at the firm. We thought, wow, they're really good. This is a good fund. We really don't want to sell them. So we took our time. Sure enough, by the end of the year, that was our #1 performing fund. So we stuck with them. And that's the thing. If you have smart people with good processes, they will have periods of 2 or 3 years of underperformance. You stick with them unless something's happened to them and maybe the market's changed, but you stick with them. And that's what Vanguard did. Vanguard would not fire a portfolio manager just because they had a year or two of underperformance. They would stick through with them. Whereas most firms like Fidelity, T. Rowe Price, USAA, boy, we were under immense pressure to get rid of underperforming managers. I remember at USA, a manager left. He had somewhat mediocre performance. He went to another firm and had great performance. And we were talking about hiring him as a sub-advisor. And I thought, well, why didn't we just keep him here if he's so good? But he just happened to have good performance when he left, even though the firm he went to had far fewer resources than we had at USA. It just doesn't make sense. These things go in cycles, and you end up chasing your tail if you're trying to find someone who's done well recently. So stay in it for the long term, hire smart people with good processes, and just stick with them. So process trumps performance because there's so much luck, so much noise in the performance numbers. You probably have seen the footnote on some investment products that says past performance is no indication of future performance. That's absolutely true, But as Jack Bogle says, our industry doesn't invest, we market. The industry pushes the best performing funds because those are the easiest to sell. And so we actually cause our own problems. So those 5 things is what I would keep track of if I were looking for a manager to hire. All right, so let's keep going on here. Pages 27 and 28. If you're going to do it yourself, so you're going to buy your own securities, then Congress passed an act in 1933 called the SEC Security Act. You probably have heard of the SEC, the Securities Exchange Commission. And this is to protect those that are doing security selection. So you hire a broker and you buy your own stocks and bonds. Your broker is going to trade through organized exchange, although most of this is electronic today, including custody. Everything's held electronically. There are over-the-counter trades. These are mainly corporate bonds and municipals. They trade in very, very large block. An over-the-counter trade is between 2 sophisticated buyers and sellers. So USAA would do over-the-counter trades to buy bonds, but they may buy bonds in $500 million blocks or $100 million blocks. Large investors, and so they don't need the protection of the SEC. They're both sophisticated, so they can do it without going through organized exchanges. But the SEC Act is protection for you as a small investor, so that stocks, when they're issuing shares, you get a prospectus, you get information on the company. They got to follow GAAP rules of accounting. They have to provide annual statements and quarterly statements, and all other statements they have to file with the SEC. They have to be audited by an outside auditor and get a clean opinion, those kind of things. So that's what this act is doing for you. What kind of trades can you do? If you're doing it yourself, you can do a market order. I do a lot of market orders just because I'm lazy, but a market order says, hey, whatever the current price is, just give me that. I want to execute right away. You can do a limit order. So if you're buying, you set a limit order that's lower. So you say, hey, I want to buy Apple stock, but I want to wait until it hits $500. Right now it's trading for $525. I haven't looked at Apple in a while, so I'm probably way off on that. So right now it's trading at $525, but you say, hey, if it hits at $500, I want to buy Apple stock. So you would put a limit order in to say buy Apple at 500. Your broker would look at that and say, well, I can't buy for 500, but if it hits 500, I'll buy it for you. Now, what happens if it closes at 525 and then next day it opens at $450? Is your broker going to buy for 500? And the answer is absolutely not. Your broker will buy it for the lower price. The broker's not going to rip you off. So you said, hey, buy for 500. So it closed at 525. The next day it opens at 470. Your broker will buy it at 470. So it's your limit order, or if it's lower, they'll get it at lower. Now, if it hits 500 during the day, they'll buy it right at 500. And so that will be your price. But if it drops below that immediately, like instantaneously or overnight, you'll get the lower price. If you're selling a stock, your limit order is the higher price. So maybe you think you want to sell Apple at 550. Right now it's 525. So you tell your broker, sell Apple for 550. As soon as it hits 550, they'll sell. If it closes at 525 and opens the next day at 575, you'll get the 575. You'll get the higher price if there's a discontinuous market, as we call it. So where the market jumps from one price to another, you won't be harmed. You'll get the better price whether you're selling or buying. You can also do a stop loss. So a stop loss is when you buy a stock, and let's say you buy it for $670 and you think, you know what, I'm buying this at $670. I really think this stock is going to take off. However, I'm a little worried about this one thing. If this announcement comes out and they don't get this drug approved or whatever, Netflix doesn't get enough new customers the next time they report, that stock price is going to drop dramatically. So I tell you what, if it hits 640, just sell, because that means I was wrong. I didn't understand this stock well enough. The most I want to lose on this stock is 670. Now, in this case, if you put a stop loss at 640, if the stock closes at 670, and the next day it opens at 500, yeah, it's not going to execute. You'll just be locked out. So you'll have to, decide what you're going to do there. So that's the scary part of it. But if it drops slowly from 670 to 660, 650, as soon as it hits 640, your broker will sell it at 640, and you'll just have to say, hey, I made a mistake. But do realize you're competing if you do it yourself, or your uncle or your aunt are doing this, or grandparents. They're competing against some really smart professionals. We have some UTSA alums that are on Wall Street. They're doing really great in this industry. They're very smart. They know these companies backwards and forwards. They spend, I say, 40 to 50 hours a week, but it's probably more like 60 to 70 hours a week following their securities. And boy, they know them backwards and forwards. It depends on where you're working. If you're on the sell side, like for JP Morgan, where you're not actually buying securities, but you're giving research to your customers, you might only follow 10 stocks. If you're on the buy side, where you're actually managing money, so you're working for Vanguard or Fidelity, there you may have 50 or 100 stocks at a time to cover, but probably in a limited number of industries. So pretty cool job if you know what you're doing and are well trained. If you're using a broker, I've heard people say my broker is really, really good. Most of them are electronic now, so you hardly even notice. But how do you know your broker is doing well? Well, you have to compare the return that they're getting you versus some benchmark like the S&P 500 or versus some peers. That's more of an issue when you're hiring a portfolio manager versus doing it yourself. But you can, if your broker is making recommendations on stocks and you follow those, so if you follow Motley Crue or whoever, Motley Fool or whoever you're following to give you advice, then Kramer, if you're following Kramer, whoever's giving you advice, you can judge them. You can't judge them from the point they make the call. You got to take in consideration when they make a call on a stock, the stock may go up just because they made that recommendation. So you need to do it. You got to do it from time. Once they said it was to go, look at the price at that time. And see how they did. So make sure you're comparing it to the point in time they make it a recommendation. If you buy the stock a week or 2 weeks later, the stock might have already gone up, and you're really not grading them. All right, so let's what we'll do next class is we'll go to the second part, and we'll spend quite a bit of time here. If you're going to hire a manager, you're going to outsource, you're not going to do it yourself, then we'll fall under the SEC Act of 1940. So we'll start there in the next class and talk about mutual funds, exchange traded funds, commingled accounts, separate accounts, and get into the details on those.